With the sudden surge in short-term rates, we're being swamped with inquiries on how best to hedge rising interest rate risk. What's a borrower to do? Hi, I'm Griffin of Derivative Logic, here to get you straight to smart. The transitory inflation debate is raging anew. Does it really imply that rate hikes are around the corner, though? Well, it's definitely getting tough to be in the transitory inflation camp these days, no doubt. High and rising oil prices are driving up energy costs, just as shortages and supply bottlenecks are proving more persistent. Housing costs just posted their fastest gains in more than a decade. To top it off, some members of the Fed's rate-setting committee recently steepened their projected rate hike paths. Financial markets are definitely listening. The swaps market is pricing around a 70% chance that the Fed will hike interest rates a quarter point at its June 2022 meeting, with another quarter point hike priced near the end of 2022. That's the most aggressive rate hike expectations we've seen in years and is a big change from what markets expected just a month ago, when the first hike wasn't expected until sometime in the beginning of 2023. What's our take? The market's rate hike expectations are overblown. We've seen this movie before. In short, markets routinely overreact only to temper their rate hike expectations later. We expect the same ending this time around. While inflationary pressures certainly look to be more persistent than many once thought, we doubt it will result in 2 quarter-point rate hikes next year, and we expect just 1 quarter-point hike sometime in the fourth quarter of 2022. Yes, for sure, supply chain disruptions are boosting prices for a wide range of goods and services and will continue to do so into next year. But these supply chain constraints will eventually ease. Expecting 2 quarter-point rate hikes next year is likely too aggressive, especially since the number of Americans employed is still millions below where it was prior to the pandemic, and given the slowing job growth seen in August and September. Whatever your opinion, there's no doubt, though, that the Fed's language is steadily shifting to imply a world of less stimulus and higher rates. For some perspective, globally, the Fed is a bit of a laggard. Other major central banks from New Zealand to Canada to Norway are already tightening monetary policy. The UK in particular is likely to be the first bank to hike interest rates, and it's only the European Central Bank that remains in a complacent position, like the Fed. As we've been saying for weeks now, long-term rates will likely maintain their recent gains and slowly creep higher into year-end. Now's the time to establish a game plan on how best to position yourself in this new world of higher rates. From all of us at Derivative Logic, have a great week.